Good morning everyone, and thank you for joining me today. We're going to dive into a very important and complex topic, navigating tax fraud challenges in divorce proceedings. Throughout this presentation, we'll explore the financial risks involved, the legal implications that come with these situations, and effective strategies to prevent and address tax fraud. This is a critical area that can significantly impact the outcome of divorce cases, so I'm excited to share insights that will help you understand and manage these challenges more confidently. Let's get started. When couples go through a divorce, the financial aspects often become quite complicated, and this complexity can sometimes lead to issues involving tax fraud. One common challenge is that disputes over money and how income is reported might tempt one party to misrepresent their financial situation. This misrepresentation could be an attempt to lower their tax burden or gain an advantage in the settlement process. These factors make the legal and financial outcomes even more complex, because everything from dividing assets to determining spousal and child support relies heavily on accurate tax information. That's why maintaining precise and honest tax reporting is absolutely critical throughout the entire divorce process. When couples go through a divorce, several tax fraud issues can arise. One common problem is hidden income. This happens when one spouse deliberately conceals wages, bonuses, or other earnings to make their taxable income appear lower. Another issue is falsified deductions, where someone might inflate deductions or claim expenses that don't actually exist, aiming to reduce the amount of tax they owe. Lastly, undisclosed assets are a big concern. This involves not reporting certain property, bank accounts, or investments during the financial disclosure process, which can unfairly affect the division of assets and tax responsibilities. These practices create serious legal and financial risks for both parties. When a divorce occurs, one of the first things that changes is your filing status. You might move from filing jointly with your spouse to filing as single or head of household, and this shift can impact your tax rates and the deductions you're eligible for. Next, the way you claim dependents also changes. This can affect exemptions and tax credits, so it's important to clearly establish who will claim each child or dependent. Additionally, your income and deductions need to accurately reflect your new financial situation. This adjustment can sometimes lead to more scrutiny from the IRS, increasing the risk of audits. That's why it's crucial to fully understand these tax changes, not only to comply with tax laws but also to avoid mistakes or any suspicion of fraud. Staying informed helps ensure a smooth transition during what can be a complex time. When going through a divorce, it's crucial to watch out for signs that could indicate tax fraud. One major red flag is when there's a big gap between someone's reported income and the lifestyle they're living or what their bank statements show. That kind of mismatch often signals something's not adding up. Another warning sign is sudden changes in income or deductions right before filing taxes or settlement deadlines. These last-minute adjustments can be attempts to hide or manipulate financial information. Also, if someone is unwilling to share their financial documents or is generally not transparent about their finances, that's a serious concern. Finally, pay attention to inconsistencies between tax returns, financial statements, and what's disclosed in court. When the numbers don't line up across these documents, it raises questions about the accuracy and honesty of the information. Catching these red flags early on can save a lot of trouble and expense down the line. When it comes to tax fraud in divorce cases, there are several serious legal consequences to be aware of. First, civil penalties can be imposed, which often include hefty fines as well as the requirement to repay any back taxes owed, along with interest. Beyond civil penalties, criminal charges are also a real possibility. Tax evasion is a criminal offense that can lead to imprisonment if proven. Additionally, tax fraud can negatively affect divorce settlements. Courts may impose sanctions or even revise previously agreed upon terms if fraud is detected. This all highlights just how important it is to be fully transparent and compliant with tax laws during a divorce. Full disclosure isn't just ethical, it's critical to avoid these significant legal risks. When it comes to preventing tax fraud during a divorce, there are several best practices to keep in mind. First, both parties need to provide comprehensive financial disclosure, and this information should be thoroughly verified with proper documentation. This helps ensure that nothing is hidden or misstated. Second, it's crucial to involve experienced legal and financial professionals who specialize in tax matters. Their expertise helps keep everything above board and compliant with tax laws. Third, maintaining regular communication between spouses, their lawyers, and accountants is vital. This ongoing dialogue helps clarify who is responsible for what in terms of tax filings, reducing the chance of misunderstandings or deliberate errors. Lastly, when any discrepancies or concerns arise, mediation or forensic accounting can be invaluable tools. These approaches bring transparency to the process and help resolve conflicts fairly and accurately. Together, these practices create a framework that minimizes the risk of tax fraud during such a complex and sensitive time. Here we have two real-world examples that really drive home the importance of being thorough and transparent with financial matters during a divorce. In the first case, one spouse tried to hide freelance income by keeping it in an unreported bank account. This eventually caught the attention of the IRS, leading to an investigation and a revision of how assets were divided. It's a clear reminder that trying to conceal income not only jeopardizes the fairness of the settlement but can also bring serious legal trouble. The second example involves joint tax returns where one party claimed excessive charitable deductions. This sparked disputes during divorce negotiations, causing significant delays and driving up legal costs. It shows how even seemingly small financial details can complicate the process if not handled properly. Together, these cases highlight the risks involved and emphasize why vigilance and expert advice are crucial when dealing with tax matters in divorce. Having professional guidance can help avoid pitfalls and ensure everything is done correctly. As we wrap up, it's important to understand how divorce and tax fraud are often interconnected, which can make both legal and financial situations much more complex. Common tactics like hiding income or assets are frequently used, so vigilance is essential. Changing your filing status or making certain claims during a divorce can significantly impact your tax responsibilities, so it's not something to take lightly. Catching warning signs early is crucial because it can help avoid serious penalties down the line. Finally, prevention hinges on being transparent, seeking professional advice, and keeping detailed records, all of which help protect your interests throughout the process.